Managing your restaurant's tips is a hidden minefield of financial risk. The Supreme Court confirmed the IRS can bill you for FICA taxes on tips your employees never even reported. This isn't an idle threat. The IRS has dedicated tip income specialists actively looking for these errors. The cost goes past back taxes to penalties and legal fees that can easily sink your business. We will show you the rules, the myths, and the powerful financial tools you're likely not using. The compliance process starts with your employee. They must keep a daily tip log and report all tips over $20 a month. Once they report $1, your obligation begins. You must pay a matching 7.65% in FICA taxes on every reported tip. You're also required to withhold the employee's share of FICA and income tax from their regular wages, not their tips. If an employee's wages don't cover the tax on their tips, the duty falls on you to have a system to collect those funds. This all culminates in an annual report for most restaurants. IRS Form 8027, summarizing your sales and reported tips. Paying 7.65% on every tip dollar adds up. Is there a way to get that money back? The answer is yes, and we'll reveal how. Let's confront the biggest myth in tip reporting, the 8% rule. Believing this puts your restaurant in serious danger. The law requires employees to report 100% of their tips. The 8% rule is just an IRS trigger for automatic allocation. Relying on 8% as your goal invites an audit. The IRS will compare that to your much higher credit card tip rate. Another compliance trap is confusing voluntary tips with mandatory service charges, like an 18% fee for large parties. The IRS considers service charges to be regular wages. Misclassifying them causes wage and payroll tax violations. So, what happens when these rules are ignored? The consequences are swift. Here are the most common audit triggers. Trigger 1. Your credit card slips show a 19% tip average, but your employees are reporting a combined 10%. Instant red flag. Trigger 2. You fail to file Form 8027. This directly signals to the IRS that you are not tracking tips correctly. And a quick way to get in trouble: deducting credit card fees from tips. Federal law allows it, but many states prohibit it. Employee underreporting also harms them. It reduces their Social Security benefits and hurts their chances of getting loans. This becomes your problem. It creates poor morale and an unstable workforce, affecting your service and bottom line. Now that you see the risks, let's talk about a major opportunity hidden inside this system to recover FICA taxes. Recall that 7.65% FICA match? You can claim a dollar-for-dollar tax credit for a portion of it using Form 8846. Here's the unusual part. The credit is for FICA you paid on tips, above the federal minimum wage, frozen at $5.15 per hour. This low threshold from 2007 means more tips qualify, maximizing your return. It's a credit that reduces your tax bill directly. So, how do you avoid the penalties and maximize this credit? By building a proactive compliance system. Recall those audit triggers? Modern POS and payroll systems solve this by automating tracking and creating an audit trail. Remember the employee's duty to report? A clear written policy is your first defense. It educates staff and ensures fairness. The full picture is this. Enforcing 100% tip reporting protects you from liability and creates the records to claim the FICA credit. For the highest level of protection, the IRS offers voluntary programs like Track that can provide audit protection. Tip compliance is not passive bookkeeping. It is an active management responsibility with real risks and substantial rewards. Understand your FICA obligations, reject the 8% myth, and distinguish tips from service charges to protect your business. Your immediate next step is to audit your current system. Review your POS reports against your payroll records. The gap is your risk. Don't wait for an IRS letter to force your hand. Take control of your tip reporting now to protect your business.